Therefore, solving our problem, we have CA Harsh Kothari ji from EY, and I speak him encyclopedia for you, who will describe in the detail about the direct tax amendment on virtual digital assets. And before we welcome our today's speaker, CA Harsh Kothari ji, I request coordinator of program, CA Somit Gopeji, for a brief introduction of CA Harsh Kothari ji. Somit Gopeji.
Yes. Good evening, everyone. Hope everyone is fine. Myself, Somit Go, practicing chartered accountant and a member of Andheri Oshiwara CPE study circle. Thank you, Jitendra Kothari ji and Utkarsh Sharma ji, CA, for giving me this opportunity as a coordinator. Welcome to our fourth virtual meeting of Andheri Oshiwara CPE study circle. Today, our topic of discussion is direct tax amendment of virtual digital assets. It gives me immense pleasure to introduce and welcome our speaker, CA Harsh Kothari ji. CA Harsh Kothari ji is a chartered accountant and also completed LLB and MCOM. He's a senior manager of EY India and has over 7 years of experience in advising clients in the financial service sector, including cryptocurrency exchange, bank, non-banking financial company, reinsurance company, global private equity fund, fintech company, payment network, foreign portfolio investor, foreign venture capital investor, and so on. He has advised clients on various income tax, regulatory issues, and work on assignment involving an interplay of tax, RBI, IR, DAI, and SEBI regulations. Sir, I welcome you on behalf of our Andheri Oshiwara CPE study circle and looking forward to hear from you. Thank you very much, sir, for coming today. And now over to you, sir.
Thanks a lot, Jitendra and Sumit, for that kind introduction. I'll just reconfirm, all of you can see my screen. It's a presentation with this slide title, Taxation of Virtual Digital Assets. No? Okay, I'll just share it again.
No, not right.
Yes.
Sure. Now, you all can see it now?
Yeah.
Yes.
Sure. Yeah. Thank you. Yeah. Right. So what I've done here, I've just prepared some slides on what the amendments are on this specific subject. And, I've inserted discussion points. Now, given that all of this is so new, right, we may not have answers to all the burning questions right now, but we will definitely have a perspective on all of those questions. And, just to give you some more perspective, I have been on a couple of calls, right, where there were many industry players and there were also some CBDT officials, right? So, we have also discussed all of these issues with them. And, more likely than not, many of these will be cleared by the CBDT by way of issuance of various circulars and clarifications. There may also be some more amendments in the coming years to, just simplify this regime and, to give more clarity on the issues on which right now there is lots of ambiguity. So the way in which we will move is that, I'll first discuss the amendments and the provisions, and thereafter we will go on to the open issues and what is our perspective on those open issues. In case there are any questions, so Jitendra ji, how do we go about questions? Like if there are questions, anyone can ask in between, or we keep
have the question answer session.
Sure, towards the end, or it can
Yes.
be sure. Yeah.
I would suggest that if anyone have a question, they can post in the chat box also. That will be fine also. So you can.
Yes, that will be there.
Yeah.
Sure, that works. Yeah. So yeah, we'll kickstart, and hopefully you all will find this session informative, and I'll be able to add some more information to all these esteemed chartered accountants. Yeah. So on this first slide, there's lots of discussion on what is the meaning of a VDA. Right now, VDA is a very new term. We have been hearing the terms cryptocurrency since last 4-5 years. We have been hearing the term NFTs since last 2-3 years. What the government did, that they coined a new term, and they are trying to make it a very broad and a very wide definition. Right, so VDA is a short form for virtual digital asset, and this definition has been introduced in Section 2 of the Income Tax Act. Now, before it came into the Act, people generally refer to as cryptocurrencies or NFTs, which is non-fungible tokens. Now we'll just come on to both these two aspects of a virtual digital asset. A cryptocurrency, the most common example is Bitcoin or Ethereum. Now, most of us may have opened our account with some of the other cryptocurrency exchanges. Like, we are seeing so many advertisements on TVs, like say CoinDCX, WazirX, CoinSwitch Kuber. These days many Bollywood superstars are also endorsing these apps. So when we open an app on any of these platforms, they permit us to trade in a cryptocurrency. Now, the most common or the most oldest and the most famous cryptocurrencies are two basically, which is Bitcoin and Ethereum. In addition to Bitcoin and Ethereum, there may be hundreds or thousands of cryptocurrencies which are being traded in the market today. Recently, like just 2 to 3 weeks back, there was a news article which said that the value of a particular cryptocurrency, which was called as Luna, it fell up to 90%. Right, so it went from $10 to $130 and it came back to $10. So there are many small cryptocurrencies which are available on some exchanges. However, the most famous names and the most oldest names are Ethereum and Bitcoin. Now I can just I can just spend a short time on how these cryptocurrencies come into existence, and why people think that they are going to be valuable in future. When the cryptocurrency concept came in, right, so it was way back somewhere, I think in 2008, and no one knows actually who was the first pioneer of Bitcoin. So they know the name, it's Mr. Nagasaki or someone, and but no one has found that person yet. So as a concept, the supply is limited, right? So in fiat currency, so fiat currency is your rupees, dollars, etc. What happens in a fiat currency is that the government has power to increase the supply of that currency as and when they want. For instance, during this COVID crisis, what we saw that the most of the governments across the globe, they went on printing lots of currency, right? So whether it's India, whether it's US, so they started printing currency and circulating that in the market, because of which obviously the value depreciates and we see high level of inflation. In order to overcome this major shortcoming that the government control these currencies, and effectively what could happen is, suppose I have say 10,000 rupees with me. If government goes on a printing spree, the value of my 10,000 will keep on reducing. So this, to overcome this shortcoming, what many computer geniuses did, that they created what we call now as a cryptocurrency. The overall limit, right? So in case of Bitcoin, there is an overall cap. So I don't remember the cap exactly, but let us say, for example, it is say 1 lakh Bitcoins. Now what happens is, the number of Bitcoins can never go beyond that specific cap. So it is like a scarce non-renewable resource. Let's say, for example, coal or petrol. We know that on Earth there are going to be limited number of mines from where coal can be sourced. So the quantity of supply has been capped in case of cryptocurrencies. And that was the entire idea, that we'll create a system which will be decentralized. No government will be able to control it. It will not be in the hands of a few powerful people. It will be completely decentralized and people will be able to use that. They also wanted to control the supply such that it is safeguarded against inflation as well, right? So these were all some of the broad objectives because of which a cryptocurrency was initially created. Now, to be very frank, because the number of cryptocurrencies today is so huge, I think this objective is really not met, because there are so many new currencies which are coming in the market on a daily basis. The supply is beyond what one would have imagined 10-15 years back, right? So this is the broad idea or the broad logic as per which cryptocurrencies were created and were introduced. Now each cryptocurrency, say Bitcoin or Ethereum, each of them operate on a distinct technology, right? And the more and more that technology finds utility in our day-to-day activities, the value of that cryptocurrency will keep on increasing. For example, Ethereum, which is again a very old currency, it is said, and many players in the industry believe, that Ethereum is going to have an extraordinary utility in the financial services industry, right? So any kind of financial contracts, FX trades, etc. Everything will be recorded using Ethereum. So many people believe that, in the coming decade, Ethereum could become more valuable than Bitcoin also. So the value of a cryptocurrency is essentially driven by the value of that technology, which is being used for creation of that cryptocurrency. So this is what cryptocurrencies are in general. Now moving on to NFTs, right? So NFTs, again, it's known as non-fungible token. Again, a fancy name, but very simply, what NFT means is that suppose now I take a screenshot of this image, what you can see on your screen, and I put it on a blockchain, right, using some technology, and it becomes a unique photograph, right? Then I can sell it. Now many industry players like say Amitabh Bachchan, Sunil Gavaskar, all of them are digitizing their old records, right? So there was news in between that Amitabh Bachchan had recited a poem which his father had written, and he digitized it and he sold it as an NFT and he made millions of rupees. Now in an NFT, what happens is I buy a digital product. It could be a digital painting, it could be a digital song, it could be a digital video, and I become a sole owner of that digital product. NFTs are again gaining momentum more in USA and other developed countries. In India, it is not yet that famous or that prevalent. But yeah, in the metaverse, right? So what metaverse is, it's a virtual world, right? So we saw a news in recent times that Mr. Daler Mehendi, he actually purchased a land in metaverse, right? That land, it's called Balle Balle land. That's what he has named it. And he will actually rent that land to any other musician who want to do concerts in metaverse. So in simple words, metaverse is just a virtual world. I can create my avatar in the metaverse, and people, so Nike, they have started selling shoes in the metaverse, right? So if I have my avatar in the metaverse, right, and if I want to wear good clothes, if I want to wear good shoes, many of these companies have started selling their products there. So in the metaverse, I can buy Nike shoes so that anyone who sees my avatar there will know that okay, fine, I'm wearing Nike shoes. All of these NFTs, cryptocurrencies could have a large utility in the metaverse as well as the gaming industry. So what happens in games also, like when we used to play, we used to see that, if I say for Counter Strike, for example, in like say 10, 15, 20 years back, we used to play Counter Strike. So when we went to play Counter Strike, and suppose I wanted a sniper, for example, and I wanted additional bullets for that sniper, I used to pay that through coins, right? Now those coins were earned in the game itself. Now what is happening is the world is moving at such a stage that I will be able to make such in-game purchases only by using cryptocurrencies or by using NFTs. So in terms of utility, there is a section of I would say computer geniuses or computer technocrats who believe that this industry is going to blow up. Many bankers per se, or economists, or even the RBI governor, they are against this entire movement, I would call, because they believe that one day they are just going to run away and people will lose their wealth. If cryptocurrency blows up, it could be a direct competition to banks, right? Because what could happen is, suppose I have cryptocurrency, you have cryptocurrency, we would just do all our activities using cryptocurrency. The interference or the involvement of the central government or the reserve bank could fall considerably low. And the central government may also find it difficult to control inflation, right? Now, if they want to control inflation, they are just increasing the repo rate, they are just increasing the interest rate such that they can control the money supply. Now, if the world moves to a decentralized stage where things are happening through bitcoins, then they may not have that control, right? Because they will not be able to control the prices or the supply of bitcoins. So this is where there is a huge disconnect between two sections in the society, and both of them have their own views, and both of them believe that their own views are correct. Right now, again, we may or may not have any view, but yeah, because it's in tax, we need to know what is happening so that we can advise our clients. So this was a brief background about how cryptocurrencies came in, what are NFTs, and what happens in the general parlance. Now, in the definition which has been introduced in section 2, the definition is extremely wide, right? So I've just placed it here through bullets. So what it means that any information, code, or token generated through cryptographic means or otherwise, which can be transferred, stored, or traded, and which represents value. Now, this could cover everything and anything under the sun. These words or otherwise, they have actually created a storm within the banking industry. Because what happens is, suppose I have a credit card and I'm using that credit card on a daily basis. I get credit card points, right? And towards the end, we can redeem those credit card points. Similar to credit card, when I travel through flight, right, I get those interjet miles, and I can use those miles for my next purchases. Now, because this definition is so wide, you know, many people believe that credit card points or miles, all of those could also be covered under the definition of VDAs. Now, while just getting covered in the definition is one part, but if any kind of points or any kind of code gets covered here, it will create lots of issues. For instance, suppose, while we'll go to those provisions, but I'll just explain the issue here. Now, suppose if I have credit card points, which the bank has given to me, and if the government says that, okay, those credit card points are VDAs as per section 2, whenever I will use those points, and we all use our points, right, to make some purchases, or we may simply convert it to cash to pay off our credit card debt. Whenever we convert those points, it could actually be considered as redemption, and I could actually be taxed on that. So there's a section which they have introduced which says that any kind of transfer of a VDA will be taxable. Now, if a wide interpretation is taken that all of these points or codes are considered as VDAs, then it could actually be very difficult for the banking industry or the airlines industry to comply with these provisions. Right now, the definition also includes NFTs. However, it says that NFTs will be specified by the central government. Now, the specification could come by way of rules, and which are not yet issued for that matter. We'll have to wait and see what the government tries and includes in NFTs. As I mentioned initially, NFTs could be, say, for example, Mr. Sunil Gavaskar, he just digitized his old poster and he sold it as an NFT, and he earned millions of dollars there. The RBI is also planning to issue its own digital currency, right? So that announcement was also made in this budget. The definition specifically says that that digital currency, which the RBI will issue, that will not be considered as VDA. Everyone is with me? I'll just pause here for a second. Yeah.
Yes.
Yeah. Now, coming on to a couple of issue points, which I've broadly covered before. One of the major issues which we believe could actually be difficult in determining the tax liability is determination of the situs of a virtual digital asset. Now, in simple terms, situs means the location. In our traditional general parlance, suppose I have a land in Maharashtra and I sell that land to someone, then the situs of that land is Maharashtra. This becomes extremely difficult to determine in case of a virtual digital asset or an NFT, right? And I'll tell you why it is important, because as per section 9, only those assets could be taxed in India whose situs is in India, right? Suppose if a non-resident person, say someone, say any singer in the USA, Justin Bieber or any other singer in US, he creates an NFT of his song and he sells it to Indians, right? Now, Justin Bieber may not, he may not pay taxes in India, right? He's sitting in US. So the question there would be that, the buyer is Indian, and at what stage is the property getting transferred to the buyer? Because that will help in determining the situs of that property, right? In terms of technology, what happens is all of these assets, they are also transferred online, right? Because I don't have to go anywhere to transfer my cryptocurrency or to transfer my NFT to anyone. What happens is, now to for people like you and me who are not so technologically advanced, we just create or we just use any of these cryptocurrency platforms to undertake transactions. So they're buying and selling a cryptocurrency is like buying and selling shares. Like, say I'm using Zerodha to buy sell shares, I use CoinDCX to buy sell cryptocurrencies. It is very easy, but everything happens online. Now there are some cryptocurrencies who have a backing. So USDT, right? It's a very famous cryptocurrency. which is backed by US dollars. So the company, and also there are cryptocurrencies which are issued at the backing of the gold. So what companies are doing, that they are say buying tons of gold, they are holding it in vaults, and having that gold as underlying, they are issuing cryptocurrencies whose value will depend on the value of gold. Now in such cases, where the underlying asset is situated outside India, right? And if somehow through the chain, through number of buy sell, if that asset comes in the hands of an Indian, it will be very difficult to determine the status of that asset. And if everything is outside India, right? So the most famous cryptocurrency exchange in the world currently is Binance, right? So it's BINANCE. So Binance.com is the largest cryptocurrency exchange across the world. Now, if I want, I can just create an account on Binance and I can simply buy and sell cryptocurrencies there also. The sellers who are selling on Binance, who may effectively sell to me, they may be non-residents, most of them, right? So all of this will eventually, if I have to trigger the taxability, I'll have to go to Section 9 of the Income Tax Act. And in order to cover any particular asset in Section 9, it will be important to find out what the situs of that particular asset is. And we all have seen the entire gamut of issues which came up after the Vodafone ruling, right? Where shares of a company which was outside India, those were also held to have be deriving value from India, and that's where they were also considered as taxable, which again came by way of an amendment in the act. So this, we believe that it could be a major issue, not only from an income tax perspective but also from a GST perspective, because even from a GST angle, determining the situs will be very important. On the other two issues, right, which I discussed initially also, that the terms used in the definition, which is generated through cryptographic means or otherwise. Now here again there are two views possible. One view is the words or otherwise would include anything and everything under the world, right? Now today, if any company is giving any kind of loyalty points, bonus points, which many companies do, right? See cashbacks also. So if there are any kind of points which are given by companies today, potentially everything could fall under the definition of VDAs. The other view, which most people want to take, is using the maxim of agestum generis, that if the terms or otherwise are following the words cryptographic means, then we will have to take the meaning of or otherwise from cryptographic, which would mean that any kind of technology similar to cryptography, if that is used, only those will be covered under the VDA. Now on one of the calls on which I was there, and on which a CBDT official was also there, so this was a pointed question which we had asked them, that what do you believe would be the meaning of these terms, and their answer was, I wouldn't say it was quite proper, because what they said, that this technology is moving very fast, right? And people could come up with a new technology say next year, and which could revolutionize everything. So in order to cover such situations, they have kept the definition wide, and they are expecting to issue circulars to exclude some of these items like credit card points, airline miles, etc. So this circular may soon be expected, and hopefully it should come within this year itself, such that we get clarity on this issue. Sure. So this was the first part, which is on the definition of VDA, which was introduced in Section 2 of the Income Tax Act. Now moving on to the next part, and this will be relevant to all the investors in cryptocurrency, which is Section 115 BBH, which has been introduced. What this section provides is that any kind of income arising on transfer of VDA is taxable at the rate of 30%. Right? So again, it's a rate section, and strangely, it is not a computation section. So right now we don't know that under which head of income this transfer will fall, right? Because say for shares also, there's lots of dispute, and there are lots of rulings, whether it will be capital gains, whether it will be business income. Similar to that, there could be some issues here also. Now moving on to the provisions which have been introduced in this act by way of Section 115 BBH. So what this section essentially says that, first of all, income on transfer will be taxable at the rate of 30%. Now, while computing the income, no deduction of any expenditure or allowance allowed except cost of acquisition. Set off of any other losses not allowed against income of VDA. Now, against these 2 points, there was lots of discussion in the parliament as well. And in a written reply to Lok Sabha, the finance ministry, they actually mentioned that, infrastructure cost incurred in mining of cryptocurrencies or any VDA will not be allowed as a deduction. Similarly, on losses, it was mentioned that, investors will not be allowed to offset gains from one cryptocurrency against losses from another. Now, these two have not been included in the act. They came by way of clarifications in the parliament. So it is not even a circular which has been issued by them. Moving ahead on the provisions, we'll come on to the issues later. So loss arising from transfer of VDA shall not be allowed against any other income as well. And it will not be allowed to be carried forward as well. So these are the broad provisions which have been introduced in section 115 BBH. Lots of issues on this section, and I've not covered all of those issues here, considering the paucity of time. But this section in itself is Pandora's box. The more you think of it, the more you will be able to, more you'll realize that okay, there's lots of ambiguity. Now, the major issue here, right, is how do I determine the cost of acquisition? To give you a specific example, say for capital gains on shares, we would typically follow first in, first out basis, right? So if I have, say, 3 demat accounts, for each of the demat account which I have, I will follow a FIFO account, FIFO basis. Whereas for business income, for stock in trade, ICDS 2 gives me 2 options. ICDS 2 says that, I could follow FIFO, or I could also follow weighted average cost method. Now, there's no clarity on this point in case of VDAs, right? So suppose, and again, the clarity is needed because we all know that these VDAs are extremely volatile, right? It's not the value just fluctuates 10, 20, 30, 40%, in a week. So it will be very important for the officials to clarify that, what is their thinking on this entire issue, or they could allow the assessees to take a call as per their convenience. Because if I am a taxpayer, say I bought something in 2013 when the Bitcoin was just say $100. Now say the Bitcoin is $3 lakh. If I bring something now and I sell it, I may just go and adopt LIFO basis, right? I may say last in, first out, because nothing is prescribed in law. I want to follow LIFO basis, and that's why I don't pay tax on this, right? And it could just lead to lots of litigation. Similarly, as I mentioned, for shares, we have a specific circular which says that FIFO has to be computed for each demat account separately. Now here, no such clarification or circular has been issued. A person could be trading in cryptocurrencies through a large number of applications, right? So there's WazirX, there's CoinDCX, I mentioned Binance, and I could have a different wallet in each of those applications. Now, how do I compute my gains? Do I total everything towards the end, right? Or do I look at it each application wise, right? Or do I do how I want to do? So all of these issues, even for general taxpayers like you and me, if we are trading in cryptocurrencies, we may end up taking the most conservative position, right? We may not want to, go into litigation or create any kind of issues for us. But yeah, there will need to be some clarity on these aspects. Another point here is, on indexation. So as we all know, Section 48 provides that for any long-term capital asset, we can claim indexation. The period for an asset to be considered as long-term is given in Section 242A. Here, there's no period mentioned, right? So what do I do? Do I consider it as long-term? Do I consider it as short-term? Now, the rate is 30% for everything. So from a rate perspective, the categorization of short-term or long-term may not matter. But if I want to claim indexation, right? So if I have been holding an asset for say 4 years, right? Then I may want to claim indexation on that. So that clarity today is again not there. And again here, my personal view is that because there is no clarity, one may not be able to claim indexation. Because as I mentioned initially, we don't even know under which head of income it will fall. Right? We don't know whether it will be capital gains or it will be business income. Now, if it is business income, then per se the point of indexation becomes relevant. However, if it is capital gains, which could be for most of the people, right? Because I'm not in, so I personally trade in Bitcoins and Ethereum, but I'm not into the business of trading in Bitcoin or Ethereum, right? I acquire them as investments. I hold them for some time and then I sell them. On the next point, right? So if I now today, if I get something as an asset, as a gift, so section 49, it says that, okay, fine, 47, section 47 says that, it's an exempt transfer. Section 49 will give me a cost step up. Section 56 will tell me, okay, fine, this is taxable in your hands. In the case of VDA, right? If someone gifts me a VDA, what will be my cost of acquisition? Again, no clarity, right? Because section 56 may still tax me, but section 49 does not provide for a cost step up in future. In case of Bitcoin miners, right? So Bitcoin miners is simply a person who is creating a Bitcoin. Just for everyone's information, today mining does not happen in India to a large scale, right? So India is a expensive country for miners. Mining happens in countries where electricity is extremely cheap. And what these miners want to do is, they want to find a place where renewable electricity is cheap. They don't want to use fossil fuels for undertaking this because it consumes lots of electricity. You have to have kind of supercomputers, and you need to have large people, lots of people putting in codes on a day in day out basis to be able to mine a cryptocurrency, right? So if you just Google, you'll find out that Kazakhstan is one of the Kazakhstan and China, they are two places in the world where people are doing lots of mining as of today. In case of mining, while it does not happen at a large scale, but it is very critical to know that what kind of a deduction a person will get. Suppose I mine a cryptocurrency, or say in case of NFTs, say Mr. Amitabh Bachchan created that reciting of poem as an NFT. Now, what kind of expenses can Mr. Amitabh Bachchan claim, right? Because he sold it for say $10 million. If there are no expenses available, that entire $10 million will be taxable at the rate of 30%. Right? So in such cases, can someone say that at least the revenue expenditure which a miner will incur, right, in terms of electricity cost, in terms of rent of the place, in terms of employees' salary, can all of these be claimed as cost of acquisition? What the section simply says that cost of acquisition will be allowed as deduction. However, what is the cost of acquisition is not clear. There was a landmark ruling of the Honorable Supreme Court of India in case of BC Srinivasa Shetty, which said that if you cannot determine the cost of acquisition in a particular case, then the capital gains computation mechanism fails, right? So in that case, what happens is that particular sale is not taxable in your hands. And I think this ruling was specifically in the case of goodwill, where a person had transferred goodwill, and he said, I cannot determine the cost of that goodwill. So the Supreme Court said, okay, fine, then it is not taxable. Can a similar argument be used in case of NFTs, which say Mr. Sunil Gavaskar or Mr. Amitabh Bachchan is selling, right? Because they are able to sell their digital products for millions of dollars only because of the fan following which they have garnered. Today, if I recite a poem and if I plan to sell that as an NFT, no one is going to pay me $10 million. However, Amitabh Bachchan is getting that because he has worked in the industry since the last 5-6 decades. Can we take an argument, right, that we cannot determine the cost of acquisition, and then applying the ratio laid down by the Honorable Apex Court of India in the case of BC Srinivasa Shetty, can we say that that particular income is not taxable? I do believe that this could be a potential argument which many of the NFT creators could take eventually, because no one likes to pay 30% flat tax on any particular income, and the section is worded so stringently that other than cost of acquisition, you will not get any other deduction. Moving ahead, if I'm purchasing any cryptocurrency in say foreign exchange, which could happen if I'm buying something on Binance.com, again, how to convert that FX purchase price into INR will be open up for debate, because rule 115, which provides for conversion of foreign currency into INR for computation purposes, that has separate rules for business income and for capital gains. So if I'm not able to bifurcate my income primarily amongst these two heads, all of these issues will arise. And this is just an indicative list, right? There could be hundred more issues which may arise, right? Whether tax audit is applicable. Suppose a person is doing lots of trades in Bitcoin and his turnover exceeds 1 crore, whether is liable to do a tax audit. Whether 44 ADA will apply. Can someone say, okay, fine, I'll just apply 44 ADA, I will not keep books, and I'll just pay 8% tax. So loads and loads of issues will arise. That's why the first and foremost point here will be, characterization of income, whether it's business income or capital gains. And once we characterize that, we will have to actually look at each and every section under the act, which is applicable to that particular head of income, to find out what all will apply for me or what all will not apply for me. On the losses point, right? And this has been making headlines across lots of newspapers, that whether losses will be allowed, will not be allowed. Now here again, the section per se is ambiguous, right? So there's no clarity in the section directly. That's why the government gave a reply in the Lok Sabha. Now here the issue arises that whether the reply which they have provided in Lok Sabha, whether it is binding on taxpayers, because it is not coded in law. Government can say anything anywhere they want, but unless it comes in the act as a statute, I may not follow that, right? Because I will say, okay, fine, I have to follow the Income Tax Act. If it is not in the act, or if it is not in a judicial precedent, I will not follow it. So here again, while the government in its intention tried to clarify things by giving a reply, however, unless it comes into the act, people may still take a contrary view. Here again, on losses, there are two kinds of issues. First one is that I only do Bitcoins, so I have incurred gains in Bitcoin, I have incurred losses in Bitcoin. Let's suppose 100 is my gain, 80 is my loss. Now, do I net that off and pay tax on 20, or do I pay tax on 100 and ignore 80? The reply in Lok Sabha is also ambiguous, so it is not clear. So a view has emerged, and which is again my view as well, that if I'm trading in the same cryptocurrency, which is say only Bitcoin, I should be able to set off the gains and losses which I incur in Bitcoin. Because at the end of the day, if I'm making my computation, I'll just consolidate all the Bitcoin transactions and arrive at a net position. If I'm doing Bitcoin and Ethereum both, if I have gains in Bitcoin and losses in Ethereum, there I may not be able to set off the loss. However, as I mentioned, people are still taking a view that because it is not codified in law and law is ambiguous, I can still take a view and set that off. Moving ahead, and just let me know if I'm going too fast, or if I should just slow down.
It's perfectly fine, sir. Perfectly fine.
Sure. I hope everyone is just trying to. I hope I'm able to make everyone understand. I mean, I do realize it's kind of new and complex, but yeah, I just hope that I try to add value to this session. Moving ahead, right now, there could be a situation where non-residents are also trading in cryptocurrency exchanges. For non-residents, again, section 115 BH may apply, because it says that it is applicable to every person. So it has not restricted its applicability specifically to residents. So as a section, it will apply to everyone. Here, though, the issue will be, which I initially covered, that what is the situs of a VDA, and whether it is covered under section 9. Suppose if I'm a person sitting in US, I'm selling my Bitcoins to anyone through say a Binance or any other exchange, and the buyer is an Indian. Just because I'm selling it to an Indian should not mean that I pay taxes in India. However, there appears to be lack of clarity on this issue, because the section is worded very widely, and there is no clarity on what the situs of a particular VDA is. Again, similar to that, there will be issue in NFTs as well, because if say with the growth of the music industry, there are so many musicians anywhere in the world who want to sell their products, and if they sell any digital item in the form of NFT to any Indian, whether that particular sale, if it has happened to an Indian person whether it will be taxable or not. Now, in case of goods, right? Suppose if I just draw a parallel, say Nike is selling its shoes in India. Now, in case of goods, it's very clear that when the sale gets completed, that when the delivery is complete, when the risk is passed, all of that is clear. However, in terms of digital products, it's very difficult to conclude on when your sale has completed, because it's all happening through technology. They just have to press one button there, you just have to press one button here, and you will be able to buy those coins. So, and again, international organizations, right, OECD and all, they are also working towards developing a framework on cryptocurrencies, and how and what could be the best possible way to tax these cryptocurrencies. So while we are closely looking at what OECD comes with, but until that happens, there will be ambiguity on these aspects. Many non-residents, they are eligible to claim benefits of a particular tax treaty, and many tax treaties, right? And most of the tax treaties, and I could name a few if you want, say India Mauritius tax treaty, India Singapore tax treaty. Most of them have a residuary clause in the capital gains article, right, which say that anything other than what is mentioned above is taxable only in the state of resident of the non-resident. To give you a simple example, suppose I am a Singapore resident, and if I am come to India and if I do some trades in cryptocurrencies, right, then still under the tax treaty I will not be taxable in India. But the only catch here is that which article to use under a DTAA, or similar to how we have different sections and heads of incomes under the local law, which is your Income Tax Act 1961. There are also articles and sections in a DTAA, right? So there may be a doubt that whether it will be business income, which is typically Article 7 of a DTAA, or say capital gains, which is typically Article 13 of a DTAA. Right. So here again, there will be ambiguity, because unless and until we get some clarity on the head of income. Now, suppose if for domestic purposes, I'm able to conclude that, this is capital gains, then similar conclusion could also apply in case of non-residents, right? So there, if I'm under a tax treaty, I will go and look at the capital gains article, and I will repeat that most of these treaties have a residuary clause, whether it's Mauritius, Singapore, or Germany, or so many other European countries. They have a residuary clause that anything other than the above will be taxable only in the state of residence. Now, typically, they have specific clauses for shares and securities. They have specific clauses for immovable property. They have specific clauses for ships. All of these laws are, quite outdated, I would say, because, these would have been drafted, say, 30, 40 years back. So they would have never imagined that, something like a cryptocurrency will come up where transfers could just happen on a click of a button. So, there will have to be some rationalization internationally as well. And many international organizations are working on rationalizing taxation laws on cryptocurrencies. So, the governments have realized one thing through the last 4 or 5 years, that it will be very difficult for them to ban cryptocurrencies. They may not be able to ban them. So the only way is to regulate them such that people who are doing it feel free, feel safe, and the tax laws are efficient for that matter. And that's why many international organizations today are working towards developing a cryptocurrency code. In recent times, Mr. Prime Minister Narendra Modi, he also gave, in one of his speech, he did mention that, we don't want to hurry with a cryptocurrency law. We'll just see how the world is progressing, and then we will come with it. Now, this law will be a broader law on regulating the cryptocurrency environment in India. Right now, some people suggest that the cryptocurrency exchanges should covered under SEBI, right? Similar to your stock exchanges. However, all of that is completely unregulated now. All these cryptocurrency exchanges do not fall under the purview of any government organization. And to that extent, it becomes slightly unsafe for investors. If I'm investor, if I'm holding my cryptocurrencies in a wallet, and if that company goes bust, right, then what do? I have nowhere to go. So this is a major risk which the government also believes. And that's why quite often we see, say, a RBI governor or some other minister or a finance minister saying that cryptocurrency is crap. and they'll just take your money away. Again, there's a concept of equalization levy under the Income Tax Act, right, which says that I'll just spend 2 minutes on what equalization levy is. So again, it's a new concept which was introduced like 2 to 3 years back. And any kind of foreign cryptocurrency, any kind of foreign e-commerce operator, so it's wide, not restricted to cryptocurrency exchanges. So any foreign e-commerce operator, when it sells any products or services in India through e-commerce, they are liable to pay a tax known as equalization levy. The rate of equalization levy is 2% at the current moment, right? So again, here there is a doubt whether these foreign cryptocurrency exchanges, like say Binance.com, whether they will need to pay equalization levy on whatever cryptocurrencies they sell in India, right? Now the 2% tax rate again is a 2% cryptocurrency, 2% equalization levy. If at all it applies, it could be very high because these cryptocurrency exchanges will never have a 2% margin on buy and sell, right? So what a typical cryptocurrency exchange is similar to a stock exchange. It will just let the buyer and seller meet each other to execute a trade, and they'll keep a commission in between. There were also significant economic presence provisions introduced under the Income Tax Act. Again, now this came in Section 9, whereby they broadened the definition of business connection. Now, this could also apply to cryptocurrency exchanges which are operating from outside India. So here again, even for non-residents, because the section has not mentioned anything specific to them, there are lots of open points on what all could apply to them from the general law. I'll just share or discuss a case study now. So this is how a typical cryptocurrency exchange may work, right? So what happens is, suppose I'm a customer, this is a cryptocurrency exchange, right? Suppose I put a buy order of say 100 bitcoins. Now sometimes what could happen is the Indian cryptocurrency exchange, it may not have 100 bitcoins to sell to me, and it may not even have a seller who is willing to sell 100 bitcoins. What it does is it places a back-to-back order on a foreign cryptocurrency exchange, which is a Binance, right? So what will happen is I place a buy order here, it will place a back-to-back buy order here, and it will buy those cryptocurrencies at say 99 per Bitcoin and fulfill my buy order. So what is happening here for the Indian cryptocurrency exchange is that it is buying a Bitcoin at say 99 rupees and it is selling it to me at say 100 rupees. Now, if I were to literally read the section 115 BBH, it says that this 1 rupees ka profit which was made by the cryptocurrency exchange, 1 rupees into 100 bitcoins, it needs to pay 30% tax on that 1 rupees profit, because the deduction is only restricted to the cost of acquisition. This is a major issue for most of these cryptocurrency exchanges, because this is their business model. Now, if I were to literally read the section, then whatever expenses the cryptocurrency exchange is incurring, right, to operate this entire business, there would be technology costs, there would be employee costs, there would be tons of other expenses. Everything could potentially get disallowed because the government will say, I'm only giving you a deduction of 99 rupees per Bitcoin, which is your cost of acquisition. So, we are currently working with I am currently working with a couple of cryptocurrency exchanges to, figure this out, and, how this can be navigated upon to reach to a conclusion, which is not so onerous on them, because this is so very difficult, right? Already their margins are pretty low. And if on that cost less selling price, if they have to pay 30% tax, it is again, it actually kills the entire business. Because generally, being an Indian company, they would be liable to tax at the rate of 20% as per the new 22% as per the new section. Here the tax increases by 8%, and the deductions which I would have otherwise claimed, they all go away, right? So it's a double whammy for me. So this could actually kill the entire cryptocurrency business if it is not rationalized properly. Now these days, what happens is, I'm not sure whether any of you has opened a account with any of these cryptocurrency exchanges, but what happens today is that, if I have a cryptocurrency account, the exchanges permit me to open a fixed deposit of my cryptocurrency. Right? So similar to how I open a open a fixed deposit with cash, the exchange will allow me to open a fixed deposit of my cryptocurrency also. So in this case study, what happens is, suppose I am a user, I have say 100 Bitcoins with me. I'll open a fixed deposit with the cryptocurrency exchange of this 100 Bitcoins. It is a normal fixed deposit like you would do with cash. At the end of the period, you will get a interest. Now that interest is also in the form of Bitcoin, right? Suppose I put 100 Bitcoin, I get 1 Bitcoin at the end of the month as interest on those 100 Bitcoin. Here again, lots of issues, lots of practical challenges which the exchanges are facing. Because what happens here is, at the first instant, if I'm putting my Bitcoins as a fixed deposit, the question arises, is it a transfer? Right? Am I transferring my Bitcoins to them? And am I liable to pay tax under 115 BHH? In our view, it is not a transfer because these funds are just getting blocked. On the second step, when they are actually giving me interest, here, the cryptocurrency exchange is actually transferring its assets to me. On that point, right? So there is actually a transfer which could get covered under section 115 BHH. So these cryptocurrency exchanges, on whatever transfers they make, because see, there's no way in of giving a cryptocurrency to someone. It will always have to be by way of a transfer. Now this could actually happen every month, every day, where they transfer loads of cryptocurrencies as interest to their users, right? And the question will arise whether they need to pay tax under 115 BHH. If they have to pay, the another issue here is what is the sale consideration and what is the cost, because there's no sale consideration, right? I just placed a fixed deposit and I got interest on that. Now for the cryptocurrency exchange, it transfers some Bitcoins to me. They are not getting a sale consideration for that. I'm not paying anything. The only sale consideration is the period for which I kept my Bitcoins as a fixed deposit. So here again, loads of issues, that whether it could be a transfer, what will be the cost of acquisition, right? And again, the TDS issue we will come to later in the slide deck. But again, the question will be, when they are giving this interest to me, which is actually a very interesting question. If whenever they pay this interest to me on my Bitcoins, whether they need to do TDS, right? So section 194A, which is interest on interest other than interest on securities, right? So could this be termed as interest under section 228A of the act? That also in itself is an open issue. If not interest, could someone say that it is because Bitcoin is like an asset, right? Could someone say that it is rent under section 194I? So many open issues on this point itself. In the next point, again, so in case of NFTs, what happens is there could be a transfer of the NFT, or there could also be a transfer of the underlying property. Now, say a painting, right? Say there's an MF Hussain painting. They have digitized that painting. Right now, I get that MF Hussain painting, and I also get the digitized painting. Now, in such cases, there could also be a possible double taxation, wherein they say that the painting is also taxable and the NFT is also taxable, both under separate heads of income. I'll just take a 2-minute break here, and I will just resume back.
Yes, sir.
Sure. Yeah. Moving on to the next amendment, which was on taxation of gift of VDA. So section 56, an explanation in section 56, that has been amended to include VDAs as well, right? So what has happened because of that is that the definition of property, right? So now as per section 56, if I receive any property for no consideration or for low consideration, then that I need to pay tax on the value of that property. What they have done is, they have not edited the definition of property. They have just added the words and virtual digital asset in the explanation itself, right? So here, what the provisions say is that, gifting of VDA shall be taxable in the hands of the recipient, subject to prescribed threshold, of course. The amount of income will be the FMV less the consideration paid. Carve out provisions such as gifting by relatives, inheritance, etc. should equally apply. This is what the amendment in law says. Now moving ahead again to the open points here. Yeah. Again, another point, another issue is in case of non-residents, right? So if I am a resident in India and if I have some VDAs and I gift them to a non-resident, whether that particular non-resident needs to pay tax on that gift. Now, these situations could arise a lot. And it could be misused also. What could happen is, suppose if I need to make any purchase or, buy anything from outside India, or if I just want to send some money abroad, people could more and more use this channel to make such payments, right? Because see, what happens is if I go to a bank and I tell them that, okay, fine, I want to transfer 500 USD to a colleague or to a friend in USA, the charges which are applicable could be insane, right? The banks could charge me lots of money to effect my remittance abroad. In case of Bitcoins, as I mentioned, it is on a single click. And people who are tech savvy, for them, so it is very easy. So what I know is that many people, they don't even keep their Bitcoins in any wallet or in any online database. They just keep everything in a pen drive. And you would have read this in many news reports also, that people have even lost their pen drives, right? So there's a guy, I think in UK, who lost his pen drive, which he says had around 1000 2000 Bitcoins, and since 4 5 years he is just trying to find that lost pen drive. So many technologically advanced people could just transfer money by using Bitcoins without using any banking channels. And it could result in transfer, right? So if I am transferring my Bitcoins to someone in USA, that person has received it. Okay, now again, practically it may not be difficult for me to say that, okay, when I have just given it as a gift to him, and it is for no consideration, right? In such cases, it will be very important to determine what happens to such non-resident who has received a Bitcoin from an Indian resident, whether it will be taxable under section 56, whether section 9 could apply, or whether he'll be able to claim any benefit under a tax treaty. All of these are open issues now. Another very important point is that for any tax under section 56, right, we need to determine value of that particular asset. And the government has prescribed valuation rules, which are typically under rule 11UA or 11UAA for that matter. And we need to see what those valuation rules are prior to determining the taxable amount. Here what has happened, that the government has not prescribed any valuation norm, right? So suppose if I give my Bitcoins to say Jitender ji, right, and I give it without consideration, even in a single day there could be a 20 to 30% fluctuation in that value. So even if a taxpayer wants to pay taxes, wants to be a good citizen, wants to comply with all the provisions, even in such cases it will be very difficult for them to comply, because there are no valuation norms prescribed, right? Now legally speaking, and there are certain rulings as well on this, if the law requires the Central Board of Direct Taxes or the Finance Ministry to prescribe certain rules, and if those rules are not prescribed, right, then the taxpayers can take a view that the section is not operational. We have seen this in past with respect to indirect transfer rules, with respect to this significant economic presence rules, that the rules came in pretty late, sometimes even 1 or 2 years later than what the section was introduced. So in the intervening period, in the absence of rules, we have taken a view which is supported by sufficient legal backing, that if there are no rules for me to comply, I cannot comply, and that's why the section per se fails. So this again could be a major point. The only the disadvantage to this is that the government could issue rules, say even on 31st March, which is the last day of the year, and they could apply it retrospectively from the first year of the year. So what we have seen that most of these rules which are issued by way of notifications, they are generally applicable from the first day of the year, irrespective of the date by when they are issued. So today, if I give a gift of VDA to someone, right, and who wants to pay taxes on that VDA, in absence of rules, he may not be able to pay. However, before the year end, if the rules come in, the taxes will have to be paid appropriately. 918 is again 918 was specific section introduced where Indians were paying any kind of money to non-residents as gift. Now technically speaking, a VDA is not considered as money, right? So there's a specific coinage act which is prescribed by the central government, wherein currency has been defined. So currency has also been defined under FEMA, right? So currency is defined there. There's a coinage act, and we have analyzed all of these acts, and a Bitcoin will not fall under any of those specifications. So it is not money, right? So per se, the sections which apply to a gift of money will not apply to a VDA unless their scope is extended. Another interesting point here is that one of the countries, I forgot the name, so El Salvador or some country, they have actually notified Bitcoins as their currency. Now, when we look at the definition of currency under the Foreign Exchange Management Act of India, it actually has a clause that, it can include any, so foreign currency can include any currency notified by a foreign country. So if one of those foreign countries, which is El Salvador, if, they have notified Bitcoin as their currency, there's actually a debate open that, whether under FEMA, Bitcoin then becomes a currency or no. I'll just move ahead. This is the last of the 4 sections which were introduced this year, and this is applicable although to everyone. However, we believe that this is going to be a very difficult section to comply with for people like you and me. Now we'll just as we have done so far, we'll just discuss the provisions first, and then we'll see what are the key issues or key open points here as well. So what the provision says that, and it is section 194S, which has been introduced in the act, it will apply from 1st July. So until today, it is not operational yet. Provisions in relation to withholding of taxes on payments on transfer of VDA to residents. Now this specifically says residents. So non-residents would generally be covered under section 195, like your any other payment to non-resident. Tax to be withheld at the rate of 1% of the gross consideration for transfer of VDA at the time of payment or credit. Monetary thresholds are applicable, and any transfer for a value less than said monetary threshold shall be exempt. So a very simple section to read. If I am transferring my Bitcoin to say Jitendra ji, and Jitendra ji pays me a consideration, and if that consideration exceeds INR 30,000, there will be withholding of 1% of the gross amount. So the entire consideration, a withholding will happen at the rate of 1%. In case where the consideration is wholly in kind or in exchange for another VDA, where there is no part in cash or partly in cash and partly in kind, but cash is not sufficient to meet the liability, the person responsible for paying shall ensure that tax required to be deducted has been paid. Right now, this is this again practically it's very difficult. We'll just come to the practical points on the next slide. Withholding provisions under section 194S should not apply in case of non-residents, where withholding will be done under 195. These will apply from 1st July. So these are broadly the provisions which has been introduced in section 194S. Now, in case like say people like you and me, right, we will always do our trades on cryptocurrencies through a cryptocurrency exchange. Now, what happens in a cryptocurrency exchange is that I don't know who the buyer is, right? Or I don't know who the seller is. Suppose I place an order on CoinDCX to say buy 1 Bitcoin today. I'll get that Bitcoin, right? I'll get that Bitcoin immediately. But I don't know who is the seller. Now, and this is very similar to how it happens in shares and securities. So what happens in shares, when I'm buying something on the Bombay Stock Exchange, I don't know who has sold that, right? And I will never be able to know that. So for me to withhold taxes on the seller is practically impossible in such cases. Now, there may be very few people in the country who will do a direct trade, like without the involvement of a cryptocurrency exchange. And these will largely be engineers and people who are very conversant with this field, who could just do a transfer using a pen drive. And those people may not even comply with the provisions, right? Because it may be very difficult to track such transactions. However, if anything is happening on the exchange, for me as a buyer, I don't know who the seller is. So the question arises, who has to do withholding there? Now there could be three answers here. One, I'll have to, the cryptocurrency exchange will have to tell me who the seller is, share their permanent account number, and I do the withholding, and I issue a certificate or whatever. Or the cryptocurrency exchange does, because it will have the data. Cryptocurrency exchange will know who the seller is, because they will have to eventually pay that seller. Or I say that it is impossible for me to withhold, and I use the doctrine of impossibility of performance, which is again covered in a couple of Supreme Court rulings in case of various other issues. That could be the third option, that I say that, okay, fine, see, I know I have to comply, but I don't know who the seller is, so I can't comply, and that's why I'm not complying. Now, practically, what people are doing in the industry is that the cryptocurrency exchanges are somewhere going to take the onus on themselves, that anything happening through them, they will ensure that withholding is appropriately complied with. There's also another section, which is section 194O, right, which is applicable to e-commerce platforms where buying and selling of goods and services happens. Now, practically, and technically also, 194O could have always applied to a cryptocurrency exchange, right? So now there may be two sections applicable to them, and 194S being the specific one, as per the interpretation of statutes law, we will go ahead with that. A question here arises that for the when section 194Q was introduced, which provided for withholding on purchase and sale of shares and goods and other securities, they created a specific carve out for transactions on a recognized stock exchange. Now there are representations being made to the CBDT to ask them that whether a similar relaxation could also be introduced for a cryptocurrency exchange. To my mind, it appears to be very unlikely, because the intent of the government to introduce this section is to ensure that data on people who are doing transactions in cryptocurrencies is available with the government. Right now, if they issue, and as I mentioned initially, most of the people in India would be doing their trades through a cryptocurrency exchange. Now, if they issue such a clarification, it will just defeat the entire purpose, because then there will be no data available with the government. There is also a concept known as swap of cryptocurrencies. So what I can do, and most of these cryptocurrency exchanges do provide this service also as well. What I can do is, if I have a Bitcoin, I can swap that Bitcoin for an Ethereum. So and this I've covered in this case study as well. I'll just go to the case study. Yeah. So what happens here is, right, I'm a user and there's a cryptocurrency exchange. I enter into a swap transaction. Right now, by swap, what will happen is I pay 1 Bitcoin to the cryptocurrency exchange, and I ask them to give me 5 Ethereums in exchange of that, again based on whatever the prevailing rate will be. So in this case, if you observe carefully, I am transferring some Bitcoins, right? And as a consideration, I am getting Ethereum. The cryptocurrency exchange, it is transferring Ethereum, and as a consideration, they are getting a Bitcoin, right? Now, the first and foremost question will be, if the consideration is not in cash, do I need to do withholding, right? Now, there again, there are precedents, and again, a Supreme Court ruling as well, which says that even if you are paying in kind, you need to do withholding, right? So now the question, now it's very clear that withholding will apply. Technically, it will apply on both of them, right? Because see, I am paying consideration for buying Ethereum and exchange is paying consideration for buying Bitcoin. So in such a case, actually both the parties will have to do withholding on each other. How do they get cash for that, right? Because the entire transaction is happening in Bitcoins or a cryptocurrency. So here the practical question will be, from where do they get cash to ensure that the TDS is paid? This will require exchanges to modify their operating procedures, right? Because what will happen is they will have to ensure that they get enough cash to pay off their withholding tax liability, then file a TDS return, issue a certificate, give it to the user. All of this might still be easy for the exchange to do, but for the user also, like say for an individual like me, if I am actually doing this transaction, I will also have to do all of this, right? I will have to collect cash from the exchange, pay it to the government, ensure that they get credit. Then the exchange will have to track, like it may have millions of users. We get data that around 8 crore users have started trading, 10 crore users have started trading. For so many people, say assuming even say 10% of them undertake a swap transaction, it will be a nightmare for the exchange to maintain this database and to follow up with all of these users. And suppose if some of the users doesn't file a TDS return, or if they don't comply with the provisions, what is the exchange going to do, right? This section, again, the intent of the government is clear, right? They want to kill the market basically, because as usual, and in absence of a regulatory law, they are not very comfortable with how things are going. This section may actually kill the market, because now what will happen is the exchange itself may not permit users to do a swap, because who will take the headache of ensuring that all of the users have complied, they get the proper TDS credit? If there's any issue with any user, who will go and follow up with them? People might just delete their apps, then how to connect with them? And for users also, they will need to ensure that the exchange does all of this perfectly, right? So this is a very big hindrance, I would say, in undertaking these swap transactions. And if I am a user, right, and if I know that there could be so many complications just because I want to undertake this one transaction, I may actually stop doing that transaction completely, because no one wants to, see, one point is how much I'm going to earn from all of this. A normal user in India is not investing a lot of their money in these cryptocurrencies and stuff. So per se, the amount of income may not be so high. Then why would anyone go through all of this pain? So if you see the points which I have, one second. The points which I have mentioned is like what I just discussed, that user is transferring a Bitcoin, whereas exchange is transferring an Ethereum. Based on the section, both the parties may be required to withhold tax. Since consideration on transfer is paid in VDA, cash to be collected prior to release of consideration, right? Because government is not going to accept VDA for TDS payment. No clarity on determination of value on which withholding will have to be done. So as I discussed initially, in absence of any valuation rules, this could again be a challenge, that at what value do you withhold these taxes? Because in one day itself, there could be a significant price movement. So I think, these were the slides from my side. Again, I have not covered indirect taxes here because, I'm not an indirect tax expert. But largely from an indirect tax as well, what view the industry is taking is that transactions in cryptocurrencies per se are outside the scope of GST. And most of these exchanges, they are paying GST on whatever fee income they earn from users. Suppose I buy something on any app, that app will charge a fee to me. On that fee, they are paying GST. However, the value of the transaction, which is the cryptocurrency, no one is paying any kind of GST on that. And again, it's recently there was a news article which said that government may impose 28% GST, right? And after that, there were many memes actually that there's 28% GST, 30% income tax, which is like your 58%, and there's 1% TDS. So almost 60% of the value will go to the government for every transaction, right? So the government's intent right now is that they are not very comfortable with this entire industry, and they know that they cannot ban it. So they're just trying to, introduce tax laws which may deter people from investing. And, based on data, it does appear that the number of transactions which are being entered on these exchanges have reduced considerably after these amendments. I think that's largely from my side, and happy to take questions and discuss further. And yeah, and I hope everyone found this informative and knowledgeable.
Yes, definitely.
Yes, definitely. This one very wonderful sessions.
Uh,
Members are
Amit,
requested.
your voice.
Yeah,
Amit, your voice is not good.
it's coming right now.
I can hear Somit sir, Somiji.
Okay.
Yeah, so I request member, if anyone have a question, they can ask directly, or you can then post that question in the chat box also.
Or members raise their hand also
Yeah, whatever convenient.
if they want the direct communication. So Harsh, my question is that the main allegation from the government side to the cryptocurrency exchanges that the money laundering and these type of the things, they are not able to justify that how the currency is coming and whom they transaction and all this. So how you think that this is the a regulator is needed for that, or what is your view?
So what I know is that practically all of these exchanges, they have started complying with KYC norms, right? So even though their KYC norms are not applicable to them, they have started complying with them. Even when I had created my account, they asked me for my PAN card, they asked me for my Aadhaar card, they asked me for my bank statement. And recently there was also a circular issued which mandated these exchanges to comply with the KYC norms. In my personal view, I do believe that we need a robust regulation around these exchanges, and my concern largely is on the custody of those assets. So again, today there's NSGL and CDSL who gives us comfort that our shares and securities are safe with them. Now
Yes.
here, and recently there was a news that one of the US based cryptocurrency exchange, it is actually on the verge of bankruptcy. So many people held their bitcoins, their cryptocurrencies with that company, and now they are not guaranteeing that they will get it back. So that, in my view, that is a very important and critical aspect which the government should definitely come in and create some regulation, that all of the assets should be held with a trustee, or should be held in an escrow account, so that they become bankruptcy remote. Today, if the exchange, if an exchange falls, right, then my assets should be safe, because if my assets go with it, then it will just shake the confidence of the entire investment community. And
What about the NFD?
for NFTs, frankly, in India, the market is not so huge, and there people are actually holding it, so they become the owners of those NFTs. Right there, again, practically, if I'm buying a poem which has been recited by Amitabh Bachchan, people are now creating businesses by which they can monetize NFTs. So I was just speaking to one person. He said, if you have any NFTs, they'll create a platform where you can showcase those NFTs. And if your NFT gets views, if people see your NFT, then you will get paid for it. But for NFTs also, the underlying technology which is there, which makes me an owner of that NFT, right? So practically how it happens is that there has to be a blockchain entry for every transaction in a cryptocurrency. Now, if I am buying an NFT, there will be a blockchain somewhere in the world. And again, no one knows where that blockchain is. So the blockchain may be different for each currency. So in that blockchain, there will be an entry that Harsh Kothari is the owner of this XYZ NFT. And the people who promote these, they say that that blockchain is your safety net, that tomorrow, even if everything goes bad, but on the blockchain there will be an entry in your name. However, for me, how will I find that out? I mean, where am I going to go to see if find mere naam pe hai nahi hai or whatever, right? So this safety and security issues of ownership are there today, And I think even in the legal practice, lots of lawyers are working towards solving these issues. And so the cryptocurrency bill, which was going to be introduced by the government, right? So initially it was going to be introduced in 2019, then it got deferred, and now it is deferred indefinitely. So in that cryptocurrency bill, they were actually so the news report suggested that they were to ban cryptocurrencies completely in India. However, I think, they got a backlash from the entire industry, from so many investors, and now that they are rethinking, I personally believe they may not ban it, but the option that, you put the cryptocurrency exchanges under SEBI purview, like, how we have NSE, BSE or brokers.
Strict vigilance and the tighter risk management system.
Right. Because I think that will be required, to ensure that the industry grows.
That will also improve the faith of the investor
Right.
also
Right.
in longer run.
Right.
Any other participant? I think no other participant having any. And in chat box also no question, no? Sorry.
No questions. Yeah.
Fine. Now I request our deputy convener, Utkarsh Sharma ji, to give heartily vote of thanks.
Hello. Yes. Yes. Thank you, Jitendra sir. Thank you, Harsh Kothari ji, for accepting our invite to deliver on this complex topic on a such a short notice. The concepts explained by you in terms of swaps, VDAs, and NFTs, etc., are insightful and will help the members to advise their clients accordingly. And I'm sure you are available to them for any sort of queries that they may have, and in case of complex issues, you are always available.
Sure.
With this, I would like to thank you for your time and this presentation. Thank you so much.
Thank you. It's my pleasure. It's been a wonderful session. Thank you, everyone.
Thank you.
Thank you.
And please share the PPT also.
Sure. We'll do that. Yeah. Thank you.
So our next physical seminar on 12th of June, and the speaker is Ramesh Prabhu, Shri Piyush, CA Piyush Chajed, and CA Dilip Agarwal ji. The topic is on the RERA taxations and the cooperative housing societies. Okay, now I'm closing the meeting. Thank you, RCG.
Thank you, everyone.
Thank you, Harsh. Thank you.